All right. This morning's training topic here on Tuesday, September 20th is risk control for options. Yesterday, we covered it for shares, but there's a different approach for options. So let's pick a trade to use for a demonstration. We'll look at our watch list that Eva does a great job keeping it updated. Here we got a short candidate triggered CNQ. So of course, all trades start with the underlying chart. Let's take a look at CNQ. And what we got here is a wave 4 trade down. So let's get some targets real quick. Retracement zone. And we are looking for, this is A, B, looking for a C leg of wave 4 down. So we would enter this trade here at the current price. And I'll just estimate these levels real quick. There's our entry. Put our stop right up here at the wick, right above the 200. And we're going to put our target down here at the bottom of the Fibonacci retracement zone. Okay. So there's our target. There's our entry, stop, and target. We got, 2 or 3 to 1 reward to risk ratio. So what option contract would we pick? Well, CNQ, I already checked the earnings. They're in November. So we're going to go ahead and pick the November contract. CNQ November, we're going to go put, we're going to go in the money. We're going to do the 55 strike put this contract right here. And it's currently trading. The ask on that is 470. So the question is, based on my account size, how many contracts should I buy? How much risk should I take? And there's 2 approaches. There's a basic approach and there's an advanced approach. And all this information I'm covering today, is available to you on the secure area of the website. You log in, and here's where you have access to stuff. You go to stock and option picks, option trading information. There's a couple of recorded videos. There's a spreadsheet, there's a study guide, and there's a link to the option calculator that we're going to use. Okay. But so here's how you use that spreadsheet that's attached. Option position size calculator. You put in your account size. Let's use $50,000. We're going to use 2% risk. So 2% risk is we're not going to risk any more than $1,000. So the basic approach would be just don't spend any more than $1,000 on contract premium, because with option contracts, when we're long, we buy them, the most we can lose is the amount we pay. And so if we take this short trade, we buy a put on CNQ, and it just goes totally wrong on us, and thing gaps up. Right, the most we'll ever lose is the 470 that we paid per contract. Never lose more. Right, unlike a stock, if you hold the shares, if it gaps through your stop, you could actually lose more. There's always that risk. But here, risk is absolutely contained. So if the price is 470, we just put that in here, and that's 470, right? And what happened with my oh, I think I got it. Here we go. You put in the actual quote price, not the the 470. So it's 4.70, and it says, hey, 2 contracts. That gets you under $1,000, right? That gets you at $940. So that's the most you'll lose. That's the basic approach. And if if you're you got a day job, you travel a lot, you can't always be at your computer to respond, maybe the basic approach is appropriate for you. Okay, so there is an advanced approach, and we'll just go ahead and use 50,000 here as well. Okay, 2%, $1,000 risk. Purchase price of the contract still 470. But what we can do is calculate, if CNQ were to hit the stop, right, how much would we expect to lose per contract? Because if it just moves up to the stop and hits it, we're not going to lose the full 470. So we use an option calculator. And the link to that calculator is in the web page that I showed you, and I'll just paste it in here if you want into the chat box. You want to bookmark that. It's a great calculator. It's based on the Black-Scholes model. And what's nice about this is it's on this options education website. The tool is actually provided by iVolatility.com. If you just go to iVolatility.com, you got to pay for the calculator. But these folks have paid for it and embedded it, and we can use it. How cool is that? And so what's nice about this calculator is you put in the symbol and all the variables that are needed to run the Black-Scholes option pricing model have been loaded. Okay. And so here's the strike price we're interested in. It's the 55. We're looking at the November contract. And what we can do is we can put in a future price of the underlying shares. And what we want to do is we want to know what the price of the contract would be at our stop. Our stop is sitting here at 55.29. At an underlying price of 55.29. It looks like I'm having a little connection issue. You guys hear me okay?
Yeah, we can. You cut out a little bit. I wasn't sure if you were trying to do something or we weren't hearing you.
Okay, so my
Can't hear you again, Dean.
calculate.
Didn't hear the beginning of that, Dean.
Darn it. Okay. So I've put, I got TradeStation blinking in and off. Okay. I put the price of the stop of the underlying shares, 55.29. I hit calculate. And what it's doing is calculating what the option value is going to be, the put option contract at this future price at our stop of 55.29. And in this case, it's saying 3.54. So I come over to my spreadsheet and I put in stop value of contract, 3.54. And it says, okay, if you pay 470 and the underlying goes up and hits the stop of, and the value, the new value is going to be 354, you're going to lose $116 per contract. And so they say for this account size at a 2% risk, you could buy up to 9 contracts. And then you're going to lose 9 times 116, right, at that stop, which would be right at, rounded at your $1,000 max loss. So 9's a lot of contracts for a $50,000 account. Maybe you want to pull that back, but it gives you an idea. You can see using the advanced method, you can get a much bigger position size with using this advanced method, using the options calculator than you would with just the basic, simple approach. So hopefully that all came across. We had a little internet glitch thingy there. Did you guys get all that? Anything you want me to repeat? Because I'm not sure what you saw or didn't see. So I'll see if you got any questions or something to repeat there. And again, Ref, you got it. Okay, good. I'm glad it all came across. This calculator, I posted the link, and this page with the option trading information, you have access to in your account. And there's the link to that posted into the chat box, right? But again, you just, you log into your account, you go to stock and option picks and option trading information, brings you to this page. There's a recorded video of what I just walked through. There's a little study guide PDF sheet, the calculator I was just using, and a link to that options calculator page. All right. So there is today's teaching topic, risk control for shares. Michael, you are very welcome. And tomorrow's topic is going to be Dow theory, really important. So we've spent a lot of time on risk control. Now we're going to get into some chart analysis, Dow theory. So you got that to look forward to. And of course, these are all recorded, these sessions, and posted each day. So if you look here, you scroll down into our training time live sessions, right? All the ones we've done so far have been recorded and posted. All right, so that is it for today's teaching time. And I'll stop this recording.